Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my own charts. This was all my own original work, as I think you deserve to have that. So with that Paris Rapeseed, we've had two patterns here, two completed patterns that have been the main influence on this market since as far back as the summer. The first pattern is an overextension of the bright red neckline, which is currently at 453 and a quarter, or the May to August 2025 head and shoulders continuation pattern. This bright red neckline also shows up in the second pattern. In this case, it acts as a lower trend line, together with the nearby bright green upper trend line, currently at 457 and a quarter. They together formed a small, shallow July to October descending wedge pattern. We had a break higher over this pattern 7 weeks ago, a good break higher, and as I said back then, and I quote, "I feel obliged to lay out, if not targets yet, then potentials." Thus a primary potential will be up in the 489 and 3/4 area, with a secondary hard to reach potential up in the 502 even area. Of course, if this becomes a false break on the upside, then I will retire these potentials in a heartbeat. End of quote. 5 weeks ago, I solidified these potentials into targets with target X, the primary at 489 and 3/4, and target X1, the secondary at 502 even. However, since late October, we've seen prices move up and away from the descending wedge pattern, but they also got caught overhead between the mauve medium moving average, currently 474 and a quarter, the gold long moving average, currently 478 even, plus the dark blue neckline extension to the August to September 2024 reverse head and shoulders pattern. It's currently 483 and a quarter, and that's been capping the market. I said 5 weeks ago, and I quote, "Pushing above the gold long moving average, and especially the dark blue neckline extension, will be key to any attempt higher. However, if prices stabilize below the mauve medium moving average, then the pressure will be to try and push that back down to the bright green upper trend line." And that's the end of the quote. Now these thoughts still stand today as prices tried pushing up through the dark blue neckline extension, but last week and this week we've seen the market push down heavily, enough that this week we have been testing a trio of supports of the June 21 low of 468 and 3/4, the 50% Fibonacci line from May 23 to January 25 move at 467 and a quarter, which actually is a possible support area, and the bright pink February 24 today uptrend, currently at 466 and 3/4. And anyone who has been following any of my Rapeseed commentaries will know that that particular bright pink uptrend is not really any support at all. Last week I was on the verge of retiring those topside targets, and this week even more so, but I will keep them on for a little longer just in case. However, as I said last week, and I quote, I would start looking at the late October to late November action as a possible double top, with potentials not targets yet of a primary potential down in the 470 zone, which the market has already achieved, and a secondary harder to reach potential down in the 464 and a quarter zone. And that's the end of the quote. As I mentioned, we've already achieved the primary potential, and today I feel obliged to formalize the secondary potential below into secondary target X3, and I'll watch carefully to see if we manage to reach down there, just above the 2013 high of 464 and a quarter. Winnipeg Canola. The key recent pattern here had been the fairly obvious bright red late June to late October bear channel. 10 weeks ago, prices spiked down to the May 23 low at 611.10 within this bright red bear channel, but then bounced up from there. Initially, not by far, as it seemed the pattern came to the market rather than the market moving to the pattern. But it did lead to prices testing and finally breaking upwards 6 weeks ago over the bright red upper bear channel line, as well as pushing up over the 2021 low at 629.5, plus the lesser Fibonacci line at 632.90, and then challenging and stabilizing over the bright green short medium moving average, currently 639.90, before 3 weeks ago making a small gapping move higher still, since filled in, over the significant combination of the June 21 low at 655.90 and the 50% Fibonacci line for 2025 at 655.70. Prices continued higher, but then unsurprisingly, ran into trouble around the slowly declining mauve medium moving average, currently at 651.80, and the extraordinarily flatlining long moving average, currently 661.90. Further above is what may be in some ways the additional cause to this halt, and that's the significant April to August head and shoulders top neckline, currently at 681.80. Thus we ended up and out of the bear channel, and we almost, though not quite, seem to start to form a small October to date bull channel. However, the bullishness faded under the capping pressure of the mauve medium moving average and the gold long moving averages, plus that 50% Fibonacci line for 2025 at 655.70. And last week prices turned lower for small November and early December base double top, and the market subsequently crashed down through it all, finishing last week below the green short medium moving average and on the 2021 low at 629.60. In the process, the primary target for the small double top at 641.40 was reached, as well as the secondary hard to reach target X down at 630 even. So where does that leave us now? Well, we have a small band of recent congestion over September to October, between approximately 616 to 633, a band we seem to be getting mired within. The question on this band is whether this will become a base for a move higher, in which case the significant overhead neckline will now come into possibly view, or whether this is a bearish halfway hesitation, with potential down to even the 585 level. Thus, this would then be below the 50% absolute Fibonacci line at 606.90, and that would be one to watch. I'm not sure on either yet, but I do favour a little the basing action idea right now. Bursa Malaysia crude palm oil. To start with, as I've done for many months now, I look to the wide congestion at its overhead between 44.08 to 45.59. We tried in mid-October to pierce it, and failed, with prices punching down through the lower edge of this congestion, as well as most of the moving averages, which we are still sliding along underneath. Prices also dropped down through a wide congestion zone made up from the 38.2% Fibonacci line of the May 20 to March 22 move, and the 50% Fibonacci line of May 23 to December 24 move, both at the same 42.74 level, along with the 38.2% Fibonacci line of the July 19 to March 22 move at 42.39, and finally the July 23 high of 41.89. These became resistances. The next recent overall pattern here is the dark blue mid-August to early October bearish Andrews pitchfork. And we have seen action in recent weeks in between the dark blue lower time below, currently at 38.86, and the dark blue middle time above, currently at 40.81. This pitchfork has in recent times been exceptional at showing the slowly declining support and also resistances. These last 2 weeks we have been testing the overhead dark blue middle time without much result. Now, stepping back a bit to view the overall picture, I said 3 weeks ago we can look at the whole August to date action as a possible double or even a triple top. If that is the case, then as I said 3 weeks ago, which is now actually 6 weeks ago, then as I said 3 weeks ago, and I quote, we have potential still available down to a primary target X in the 41.18 zone and a secondary hard to reach target X1 down in the 39.40 zone. End of quote. The primary potential and target was achieved, though we still have the secondary, harder to achieve potential and target X1, a little lower in the 39.40 zone. I also added 3 weeks ago, and I quote, additionally, the whole mid-October to date action could also be seen as a possible descending scallop pattern, which is like a reversed letter J. We have had the drop, then the rounding base over the last 2 weeks, and then today could be the last day of the 3-day bearish evening star pattern, though that is not yet determined. But if it is, then we could see a test of the base of the recent action in the 40-50 area. We could then have potentials and even targets below. I'm not yet comfortable with this pattern idea to lay out targets or even potentials below, but I would like you to be aware of it just in case, especially after October's monthly key reversal down. End of quote. This is still the case, and I'm watching carefully for future possibilities below. I should also mention the small bright green diamond pattern formed up between early November to early December, which we exited out on the downside this week. This has a primary potential target X2 down in the 39.20 zone, just under the earlier target X1, and a secondary hard to reach target X3 down in the 38.10 zone. In the way, should we try and head lower, and this showed up 2 weeks ago, we have, as I said 4 weeks ago, and I quote, "We do have a band of congestion below around the dark blue lower tine between the February 2011 high at 39.53 and the lesser Fibonacci line at 40.26. However, to be honest, this is not that powerful a congestion, and it seems enough for now, hence the stalling ahead of target X1. End of quote. This is still the case, so watch out for congestion at 39.53 up to 40.26, much as we saw yesterday. There's one other feature which I would like to discuss, something I've already mentioned since June. This all came out because at the end of June, speaking about it in a presentation at the Biofuels International Conference and Expo in Brussels, Belgium, I've also recently spoken about in November at the 28th World Ethanol and Biofuels Conference in Brussels. It was and is to watch out for a key level from now until the end of this year, so not that far away now. That level is 35.99. Now, I've always prefaced this by saying this, and I quote, that is quite a way below the market, but still nevertheless it is important, end of quote. Well, we're a lot closer to that level, highlighted in my daily chart in a black line box, than we were back in mid-October, and that is why it's important. You see, if prices push down below 35.99 before the end of this year, which I admit seems far away, then we would have set up the conditions here in palm oil to make that rarest of patterns an annual key reversal, with all the implications such a huge long-term pattern may bring. Please watch out for this, as it is important, and I'll bring you more details should we get down near or below this important level, even though I know, as we are today, still a few hundred ringgits above it. Just please bear it in mind, as we still have some time left before the end of this year.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.